Hello and welcome to IFRS Talks, your source for all things IFRS. I'm your host, Pandya. In this episode, I'll be speaking with Karsten Ganssauge, a partner at PwC and an IFRS Interpretations Committee member, for an overview of the June 2025 IFRS Interpretations Committee meeting. Hi, Karsten. It's great to have you on the podcast today.
Great to be here, Anu.
Now, I understand that this is a very special episode because the June meeting marked your last meeting after a 6-year tenure as a committee member. Is that right?
That's right. And what a journey it's been.
I definitely want to take some time later to hear your reflections on these past few years. But first, let's dive into the June agenda because I understand it was quite a jam-packed one.
Absolutely. Let's get into it.
Perfect. So this time we have a mixture of agenda items. We have a follow-up on a tentative agenda decision about assessing indicators of hyperinflationary economies. We have 2 brand new submissions related to IFRS 9. One's a question on transaction costs and the other's a question on embedded prepayment options. We also have a matter on consistent application, which is connected to IFRS 18. And then also one ISB project on business combinations, disclosure, goodwill and impairment, where the committee's feedback was requested. So there's lots to cover and let's get into it. And let's first start off with a tentative agenda decision on assessing indicators of hyperinflationary economies. Now, we have discussed the submission on the December 2024 episode in quite some detail. But Karsten, could you please remind us briefly of what this issue is about?
Certainly. So as you said, we originally discussed this matter in the November 2024 meeting and issued a tentative agenda decision, or TAD, at the time. So overall, inflation has accelerated in many regions of the world, and we observe a growing number of economies that become hyperinflationary. So obviously, this topic is only relevant for entities that have operations in such hyperinflationary economies. But for those who do, hyperinflation accounting can be quite a substantial issue. Now, for background, IAS 29, the accounting standard on hyperinflation, does not set an absolute rate for what is considered hyperinflation. So judgment is necessary, and an entity needs to consider the characteristics of the economic environment, and IAS 29 provides some indicators in that respect. So the submission asks whether all the indicators set out in IAS 29 must be considered, including whether to continue to consider all indicators even when one of the indicators has been met, whether further indicators should be considered, and whether a parent and a subsidiary need to reach the same or a consistent conclusion on the matter. In summary, evidence gathered by the committee indicated that stakeholders do not conclude that an economy becomes hyperinflationary based solely on one of the indicators listed in IAS 29. Stakeholders do consider indicators other than those listed in IAS 29 when relevant. And generally, there isn't a different conclusion reached at different levels within a group preparing financial statements using the same basis of preparation. So that evidence indicated little, if any, diversity in understanding the requirements for assessing whether an economy becomes hyperinflationary. Consequently, based on its finding, the committee concluded that these matters do not have widespread effect and tentatively decided not to add a standard setting project to the work plan. So I've intentionally kept this on a rather high level as we have covered the issue in more detail already in the previous podcast. For listeners that are interested in more specifics, I recommend you go back to the podcast that we published in early December about the November 2024 IFRIC meeting, where I provided some more details on the matter.
Perfect. Thanks, Karsten. Now, what comments did the committee receive on this tentative agenda decision, and what did they decide to do next with this matter?
So most respondents agreed with the committee's conclusion that the matter raised in the request do not have widespread effect and to not add a standard setting project to the work plan. So therefore, at the June meeting, the committee decided to finalize the agenda decision. Therefore, the next step would be for the ISB to confirm it does not object to the agenda decision at a future ISB meeting. Now, let me add one observation on the wider discussion that took place during the meeting, which I think might be of interest to some of our listeners. So there was actually quite a strong push from some committee members pointing out that hyperinflation is becoming more and more prevalent, especially in Africa and also some other parts of the world, and that some aspects of IAS 29 should be reconsidered by the board. Now, One of the key aspects that keeps coming up is around the consistency of the assessment, whether a particular economy is or is not hyperinflationary at a particular point in time. Now, that can be judgmental in some situations when assessing for particular economies whether these are hyperinflationary at a particular point in time or not. Now, we obviously deal with judgments in the area of accounting all the time on a regular basis. However, this one is quite different, I think, from other judgments. I think the important difference in this case of judgment is that unlike other judgments that are typically entity-specific judgments, this one is not an entity-specific assessment, but rather a country-specific assessment. And so it would be expected that stakeholders reach the same conclusion about whether a particular economy is hyperinflationary or not. Now, even though that is the expectation, which is, by the way, even pointed out by IS 29 itself, in practice, this is not always the case, which clearly does create some issues in territories where different stakeholders reach different conclusions on whether a particular economy is hyperinflationary. So one of the asks that have been coming up from stakeholders is considering whether the board could do something to help with more consistency in making that assessment. So I think the board is hearing that message and will consider as part of their current agenda consultation how to prioritize and potentially address this issue.
Okay, that's very interesting. Thanks, Karsten. That additional insight was very helpful. So thanks, Karsten. Let's move on then to the next couple of agenda items. And those include 2 new IFRS 9 related submissions. So let's start off with the one about transaction costs. What was this submission about?
So for background, as many of our listeners will be aware, IFRS 9 requires transaction costs related to the issuance of a financial instrument to be included in the amortized cost measurement of that instrument. Now, the submission describes a fact pattern in which an entity intends to enter into a loan agreement with a bank and incurs legal and advisory fees while analyzing the terms and conditions of the proposed loan. The entity expects to proceed with the arrangement, but the loan contract has not been signed as of the date the entity's financial statements are issued. So the question was essentially whether these costs that are incurred prior to signing the contract can be considered incremental and thus can meet the definition of transaction costs in IFRS 9. The difference in accounting being that if it's not an incremental transaction cost, the cost would be expensed as incurred. But if they are transaction costs directly attributable to the issue of the loan, these costs would be capitalized by deducting the cost from the fair value of the loan as part of the initial measurement.
So what were the committee's findings on this one?
So based on findings from outreach performed, there was no evidence of diversity that could have a material effect on entities' financial statements with regards to determining and accounting for transaction costs incurred prior to entering into a contractual arrangement. Now, the feedback from outreach suggests that costs that are directly attributable to the origination or issuance of a financial instrument and incurred prior to entering into the contractual arrangement can be incremental and accordingly transaction costs. And such costs are recognized by entities in the statement of financial position, often as prepayments or other assets. So based on this feedback, committee members tentatively decided this matter does not have widespread effect and not to add a standard setting project to the work plan. Now let me add a personal observation from the discussions at the committee that go beyond what will be included in the TAD. So I think it's interesting to note that other IFRS accounting standards, such as the revenue standard IFRS 15 and the leases standard IFRS 16, have similar guidance on costs that are incremental, but the exact wording is slightly different, and there are substantially different requirements on the related accounting, which may have been at least part of the reason why the question came up. So with that in mind, my sense is that it's important to note that the conclusion in the TAD relates only to transaction costs incurred for financial instruments, and so the TAD cannot be analogized for the purpose of applying other accounting standards such as IFRS 15 or IFRS 16.
Okay, now that makes sense. Thanks, Karsten. All right, so then if we move on to the next IFRS 9 related submission, this one was about embedded prepayment options. So what was the question on this one?
So for background, as a reminder to our listeners, when you have a prepayment option in a debt contract, IFRS 9 requires an entity to assess if the prepayment option should be accounted for separately from the debt host contract as a derivative at fair value through profit or loss. So this is actually a very common issue in practice. A simple and typical example is a bank loan that includes an option for the borrower to prepay the loan at an earlier date. One of the conditions for separation is that the prepayment option is not closely related to the related host debt contract. On the other hand, if a prepayment option is closely related, it is not accounted for separately, but instead accounted for together with the related host contract. That is the bank loan in my example. Now, there is guidance in IFRS 9 that explains when a prepayment option could be considered closely related to the host debt contract. And one of these instances is when the exercise price of a prepayment option reimburses the lender for an amount up to the approximate present value of lost interest for the remaining term of the host contract. Now, these requirements go on to define lost interest as the product of the principal amount prepaid multiplied by the interest rate differential, and to explain that the interest rate differential is the excess of the effective interest rate of the host contract over the effective interest rate the entity would receive at the prepayment day if it reinvested the principal amount prepaid in a similar contract for the remaining term of the host contract. Now, the question in the submission was about the reference to the entity in this requirement in IFRS 9 and whether it should be read as referring to the lender or the reporting entity, which is the borrower. So the submission pointed out that this is an important distinction because the borrower, in this case, is not in the lending business, so would therefore be expected to receive a reinvestment interest rate that is lower than what the lender would be expected to receive. So depending on the interpretation, you might get to a different conclusion on whether the embedded prepayment option should be separated from the debt host contract or not.
Okay, got it. And what were the committee's findings then on this one?
So similar to the previous matter, based on findings from outreach performed, there was no evidence of diversity that could have a material effect on entities' financial statements with regards to interpreting the term the entity in the relevant paragraph in IFRS 9. Now, feedback from outreach clearly suggested that stakeholders read the requirements as referring to the lender. Considering this, committee members tentatively decided this matter does not have widespread effect and not to add a standard static project to the work plan. It's maybe also interesting to note that there were some suggestions at the committee meeting to potentially clarify this matter as part of an annual improvement. So you may potentially see this issue again as a clarification as part of the next annual improvement.
Okay, well, that's good to know. And it's interesting because I know our PwC guidance actually does refer to the entity in this requirement as the lender. So that's actually pretty consistent in terms of where the committee got to on this one. All right, so if we move on then to the next agenda item, which relates to consistent application. And this one is a little bit of a different agenda item to the ones we've usually discussed. I think this relates to updating existing agenda decisions for IFRS 18. Karsten, which agenda decisions are these that are being updated?
So there are actually a lot of agenda decisions out there that refer to IS1 at the moment. So some of them focus on IS1 requirements that either have or have not been brought forward unchanged to IFRS 18. However, other agenda decisions refer to but do not focus only on requirements in IS1 that may or may not have been brought forward unchanged to IFRS 18. So they deal with issues that are covered by IS1 and also other IFRS accounting standards. So naturally, agenda decisions that deal with issues that are covered by multiple standards are more difficult to update, especially if the aspects that relate to IS1 have not been brought forward unchanged to IFRS 18. So on a high level, the staff is proposing to withdraw 2 agenda decisions where the board has developed new requirements in IFRS 18. So these would no longer be applicable once IFRS 18 becomes effective. To update the references for 3 agenda decisions that focus on questions about requirements in IS1 for which the requirements in IS1 have been brought forward unchanged by simply updating the reference, and to update another 26 agenda decision, which include explanatory material that, in addition to referring to other standards, reference requirements in IS1 that have been brought forward unchanged to IFRS 18 or other IFRS accounting standards. So where the references in the explanatory materials will be updated accordingly. And then, in addition to that, there are 10 more agenda decisions that refer to, but do not focus only on the requirements in IS1 that were not brought forward unchanged. So these 10 agenda decisions are more tricky to be updated as IFRS 18 becomes effective and therefore need some more thorough analysis.
Okay. And so did the committee's discussion focus then more on these latter 10 agenda decisions?
Yes, that's right. Because the requirements in IFRS 18 have changed as compared to IS1, these agenda decisions cannot simply be updated with references to corresponding paragraphs in IFRS 18. Therefore, one option was to withdraw these agenda decisions when IFRS 18 becomes effective. However, the ISB has considered the matter and was of the view that withdrawing these 10 agenda decisions in their entirety would not support consistent application, and therefore considered at its recent board meeting in April whether and how to update these 10 agenda decisions. So based on this, the ISB decided to ask the committee to consider replacing the references to IS1 with references to the new requirements in IFRS 18. And on one of these agenda decisions, the situation is more complex. That is the agenda decision on supplier finance or reverse factoring. So therefore, the board asked the committee to consider that agenda decision separately. And due to the more complex nature of updating that agenda decision, the staff have prepared a separate paper just focusing on that agenda decision on reverse factoring. The updates needed to this agenda decision were more extensive because the committee is not able to simply replace the references to IS1 with references to the new or amended requirements in IFRS 18. And that's because the new requirements in IFRS 18 might apply not only to the part about presentation in the statement of financial position, but also to other parts of the agenda decision. For example, there are requirements in IFRS 18 about the roles of the primary financial statements and the notes, and the requirements about aggregation, disaggregation also apply to the statement of cash flows.
All right, okay. So then what are the next steps for these 10 updated agenda decisions?
Yeah, so the proposed updates to the 10 agenda decisions will be published as one package as part of the IFRIC update for the June meeting. Now, in terms of the committee discussion for those 10 agenda decisions, I think it's helpful to differentiate, to separately discuss the one on supply chain financing or reverse factoring and the other 9 agenda decisions. So on a high level for those 9 agenda decisions, the committee suggested to keep the changes to a minimum so as to avoid any potential unintended consequences. There was some debate as to whether these 9 agenda decisions or perhaps even all agenda decisions that need to be updated should be rediscussed by the committee to consider any broader implications that may need to be integrated, either as a result of the implementation of IFRS 18 or for some other developments that may have occurred since the related agenda decisions were originally issued. But some committee members, including myself, were concerned that that might be quite an extensive effort, and also it would seem inconsistent with what the board has asked the committee to do. So a lean approach to 9 out of those 10 agenda decisions. However, on the 10th agenda decision on supplier finance or reverse factoring, the committee members generally acknowledged that due to the history and complexity of that particular agenda decision, the situation was quite a different one, and the lean approach would likely not be helpful to stakeholders. So the proposal is to update that agenda decision with a bit more guidance, similar to the way it has been drafted in the related staff paper for the June IFRIC meeting, with only a few relatively small amendments, rather than cutting down substantially the staff proposals as proposed for those other 9 agenda decisions. So personally, I completely agree with that approach, as I think analyzing the impacts from IFRS 18 on that particular agenda decision will be more challenging than for some of the other agenda decisions. So I think we should be as helpful as we can for our stakeholders, whilst of course balancing that with the risk of unintended consequences. So some good discussions there, and I think a reasonable approach forward. Finally, it was also discussed that it might be helpful to explain somewhere in the bound volume the process that the committee has gone through to update these agenda decisions, so people understand the process, including what the committee has done and what it has not done when updating these agenda decisions. Now, consistent with the process for any tentative agenda decision, the staff suggested that stakeholders will have 60 days to comment on the proposed updates. However, the committee suggested that 60 days may not be enough in this particular case, so therefore the comment period will likely be extended to 90 days to give stakeholders sufficient time to respond. Finally, I think it's important to highlight that the committee is asking for feedback only about the proposed updates that have become necessary as a result of IFRS 18. So in other words, this is not intended to be an opportunity to comment again on other aspects of the committee's technical analysis included in those agenda decisions.
Okay, understood. So the feedback that's required from stakeholders is supposed to be very focused and targeted to the specific updates that have been made for IFRS 18?
Yeah, that's correct.
Okay, that's very helpful. Okay, all right. So that was quite a interesting discussion there on the IFRS 18 updates to agenda decisions. If we can then move on to the next item, which was an ISB project that the committee was asked to provide feedback on. And that discussion was about the project on business combinations, disclosure, goodwill, and impairment. So Karsten, how were those discussions?
Sure. So for background, as many of our listeners will be aware, following feedback received on the post-implementation review of the business combinations standard IFRS 3, the board published in spring 2024 an exposure draft proposing to amend some of the requirements in IFRS 3 and also proposed some changes to the impairment standard IAS 36 to improve and simplify some of the impairment test requirements. The proposals relating to IFRS 3 are intended in particular to improve the information companies disclose about the performance of business combinations. Now, those that have been following this project would be familiar with the fact that the exposure draft had proposed requiring entities to disclose performance information for only a subset of material business combinations. For this subset of material business combination, the proposal was to require entities to disclose the actual performance of the business combination in years after the acquisition and whether the actual performance is meeting expectations. Now, the exposure draft proposed a threshold approach to identify the subset of material business combinations for which this performance information would be required. This included quantitative thresholds and also qualitative thresholds. Now, feedback on the proposed threshold approach included feedback suggesting to instead develop a more principle-based approach, such as a rebuttable presumption approach. So the committee was asked for feedback on how a potential rebuttable presumption approach could work. Now, feedback from committee members on this were a bit mixed. Some committee members had sympathy for a rebuttable presumption approach along the lines described in the related staff paper, but I think it's fair to say overall that many committee members felt that the rebuttable presumption approach would not necessarily support consistent application. And so many felt that the board should stick with some variation of the threshold approach. Now, I think there were quite a few concerns on specific aspects of the threshold approach. For example, some were worried that the 10% quantitative criteria might capture too many business combinations, potentially creating costs for entities that may exceed the benefits. Also, many felt that the 10% operating profit threshold may often not appropriately capture the right subset of business combinations, and so it should potentially be removed. So some quite interesting discussion, but I think it's fair to say that most committee members recommended to keep some variation of a threshold approach, potentially combining it with some form of a rebuttable presumption approach. But my sense was that there was certainly not much support for switching to a rebuttable presumption approach altogether, mainly because even though a rebuttable presumption approach might have some conceptual merits, it would likely be quite difficult to operationalize from a practical perspective and might be difficult to apply, difficult to audit, and also difficult to enforce. Now, that's just a high-level summary. Overall, this was certainly quite an interesting and lively debate. So if you're interested in more details, I suggest you listen in to the committee's discussion, which, as always, is available on the ISB website.
Perfect. Thanks, Karsten. That definitely sounds like it was a lively debate. And just a note to our listeners, tentative agenda decisions relating to these 2 new IFRS 9 submissions and the updates to the 10 agenda decisions for IFRS 18 will be open to comment on the IFRS Foundation's website. So, Karsten, that was really a packed agenda, and I think, all those insights that you've brought to our discussion were very insightful and helpful. And, it sounds like you were really kept busy right till the very end. Which brings me to what I was hoping to discuss next with you, which was, this was your last IFRS Interpretations Committee meeting after 6 years. You've been a member of the committee since July 2019, and I think it's certainly been an eventful 6 years, including a pandemic, geopolitical conflicts, and, in general, an uncertain economic environment. So that makes me think, what's been the most challenging matter that you've grappled with during your time on the committee?
Well, that's a good question, but not an easy one. I note that you ask about what has been the most challenging, not what has been the most difficult technical accounting question. I think that's probably the right question to ask because, one of the key criteria for selecting committee members is their technical expertise. Also, committee members have quite a broad range of backgrounds, covering mainly representatives from the audit firms as well as preparers with a strong technical background. And so committee members typically bring along a lot of experience in dealing with technical accounting questions. In addition, we have the wonderful staff of the IFRS Foundation, who are also very experienced in dealing with technical matters and really helpful in preparing the issue for discussion. And in addition, are always mindful about the governance process covered by the Due Process Handbook. So they sometimes very helpfully remind committee members about the boundaries on what we can and what we can't answer as a committee. Given that in accordance with the Due Process Handbook, our role is to interpret the existing requirements and be mindful not to go beyond the requirements in IFRS accounting standards. And even though we sometimes struggle to get consensus, I feel that struggle and those intense discussions, which are sometimes quite controversial, actually help to get a very robust technical analysis and at the end get to a reasonable solution for the respective matter that has been submitted. So that's sometimes a bit of a struggle, but I don't really see this as a challenge, as I'm confident we will be able to tackle these technical matters. It may sound a bit nerdy, but it's actually one of the things that I've enjoyed most about the committee, working with all these talented people and other stakeholders to get to the right technical solution. So to be honest, what I perhaps slightly underestimated when I joined the committee 6 years ago is how important it is to be mindful about what the due process requires and to think very, very carefully about the exact wording of an agenda decision. Now, many folks that are less familiar with the committee's process think quite simply you would submit a question and then the committee will come up with an answer to that question. But actually, that's not necessarily the case. There are very clear criteria in the Due Process Handbook on how to deal with a submission. And depending on those criteria and how they relate to the submitted fact pattern, there are multiple ways in which the committee could deal with a submission. So what I learned along the way during those 6 years at the committee is how important it is not just to think about the technical accounting questions, but to think very carefully about the process as well. And finally, what can also be challenging is when stakeholders have a vested interest and are looking for a particular outcome or answer from the committee. Now, the committee follows a clear governance process and will independently assess the method to come up with the right technical answer, which naturally means that there sometimes will be situations where some folks may not like the answer. So that can sometimes be a challenge, but I think you have to be true to yourself and do the right thing, which is to be mindful of your role and independently assess the matter to come up with the right technical answer, whilst of course also aiming to be helpful to stakeholders to the extent we can. For example, by providing additional explanatory material on the matter to help with consistent application and to facilitate stakeholders' understanding of the rationale for our conclusions.
Thanks, Karsten. That was really, you really gave us a behind the scenes perspective, I think, on what this last 6 years have been. So thank you for that. And what would you say has been the most, your most favorite matter that you've dealt with as part of, these last 6 years at the committee?
Oh, it's hard to state a single favorite topic or submission. Now, as you may know, I have a financial instruments background, so I, of course, love anything related to financial instruments. However, I think one of the great things about the committee is that you get to deal with a very broad range of topics. Now, I've been working in the financial reporting world for almost 30 years now, so I would say I have quite a broad experience. However, there are still new topics coming up all the time, which means always new challenges to tackle. So that's really great. And finally, I get really excited about cross-cutting topics. So covers topics that cover the interaction of multiple standards, which I think are often the most challenging topics from a technical perspective. So I really like dealing with these complexities. So I love dealing with those cross-cutting topics as well as new emerging topics. That's what makes my job and also this role so exciting, I think. And you get to deal with new topics or new aspects of topics that you hadn't really thought about all the time.
Okay, noted. Now I think we know where to come to when we have some cross-topic, cross-cutting issues. I also understand, Karsten, that you were a speaker at the IFRS Foundation conference, which took place earlier this week. Are you able to share a little bit about what you spoke about at the conference?
Sure. So I ran 3 sessions on the IFRS Interpretations Committee, focusing primarily on how the committee process works and tackling some FAQs about the work of the committee. So, for example, we discussed what is meant by consistent application and why it matters, what the process is of answering a submission the committee has received, and what factors to consider in that process, how agenda decisions address questions, and the toolkit of the committee to address these questions. So essentially responding to some of the FAQs we often get and giving folks an opportunity to ask questions in those workshops. So some really good discussions there too at the Foundation conference. And it was also a great opportunity to catch up with folks that I otherwise don't see that often. So I actually met a few former colleagues, some of which I had not seen for a very long time. So that was really great too.
Thanks, Karsten. And I'm sure all of our listeners will agree when I say that it's been really valuable to hear your insights about the IFRS Interpretations Committee meetings over these past few years. You've really been our standout recurring guest on the podcast, and I'd just like to thank you for all of your previous contributions to these discussions. And I do hope to have you back on the podcast in the future, but maybe we'll be discussing something other than the committee's agenda items.
Well, thank you, Anu. It's been a pleasure being a regular guest on the IFRS Talks podcast, giving folks hopefully a good summary about what has been going on at the committee. Now, as you know, we often spend a full day or more discussing these issues, and most people don't have the time to read all the staff papers or listen into the actual discussions at the committee. So I hope my high-level summaries of those meetings have been helpful to folks. I have to say that it was also such a great experience to be on the committee. I really, really enjoyed it very much. I'm a little sad my term ends, but mostly I'm just grateful for this wonderful experience and the opportunity to work with such a bunch of talented people at the committee, with the observers, and of course with the wonderful staff of the IFRS Foundation. So I just want to say thank you to all of them. It's been a great ride and a wonderful experience.
No, thanks, Karsten, and congratulations for your amazing tenure. And I'm sure you'll be missed at the committee, but I'm glad that we'll still continue to, interact on other issues. So thank you again, and thank you to our listeners. And to never miss an episode, remember to subscribe wherever you get your podcasts. And until next time, happy accounting and reporting.
This podcast has been brought to you by PricewaterhouseCoopers LLP. This content is for general information purposes and is not a substitution for consultation with professional advisors.